Welcome to our deep dive into assurance, attestation, and internal auditing services. Before we start our journey today, let me share my guiding principle. To learn accounting, you must do accounting. Just as you can't learn to swim by reading about water, you can't master assurance without rolling up your sleeves and examining the evidence. Today's lecture will equip you with both theory and practical understanding of these vital services. Think of the business world as a massive orchestra. Assurance professionals are the conductors ensuring every instrument plays in harmony to create financial symphonies that investors, regulators, and the public can trust. In today's world of Theranos collapses and FTX implosions, these services aren't just academic concepts. They're the immune system of our financial markets, detecting and preventing the viruses of fraud and misrepresentation before they can spread and cause economic pandemics. As Warren Buffett wisely noted, it takes 20 years to build a reputation and 5 minutes to ruin it. Assurance services help businesses protect that reputation by ensuring their financial disclosures reflect economic reality. Slide 2. Understanding assurance, attestation, and auditing. Let's establish our foundational concepts by visualizing a Russian nesting doll. The largest doll represents assurance services, independent professional services that improve information quality for decision makers. Why do these services exist? Because in markets, trust isn't given. It's earned and verified. Assurance services bridge the trust gap between information providers and users, reducing information asymmetry that would otherwise make markets inefficient or even dysfunctional. Like a financial polygraph test, assurance services determine whether information is telling the truth. Inside this largest doll sits a smaller one, attestation services. These occur when a practitioner issues a report expressing a conclusion about the reliability of an assertion made by another party. The key distinction: attestation always involves a written report expressing a conclusion about an assertion. It's like having a respected food critic publicly rate a restaurant. Their professional reputation stands behind their opinion. Why is this valuable? Because markets price risk. The more uncertainty about information, the higher the risk premium demanded by investors and other stakeholders. Independent attestation reduces this uncertainty. Finally, nestled at the center is our smallest doll, auditing. The OG of assurance services, auditing specifically examines financial statements against established criteria, usually GAAP. It's the ultimate verification tool, like carbon dating for financial claims. These three services form concentric circles of trust, each with increasing specificity, but sharing the same core purpose: enhancing the reliability of information for better decision-making. Slide 3. Types of assurance services. Assurance services have diversified beyond traditional audits like branches from a tree trunk, each addressing specific information needs in our complex economy. First, risk assessment services. Think of these as the business world's early warning system. Just as meteorologists help us prepare for storms, risk assessment professionals help organizations identify, quantify, and respond to threats before they materialize. When Silicon Valley Bank collapsed in 2023, many wondered why risk assessment didn't flag the obvious interest rate vulnerability. These services matter because in business, like chess, those who think several moves ahead usually win. Second, business performance measurement, the corporate equivalent of a comprehensive health checkup. These services verify whether an organization's vital signs, KPIs, actually measure what matters. As management guru Peter Drucker observed, what gets measured gets managed. These services ensure companies measure the right things in the right ways. JP Morgan doesn't just want to know quarterly profits. They need reliable metrics on customer satisfaction, operational efficiency, and dozens of other performance indicators that drive long-term value. Third, information system reliability. These services are the digital bouncers ensuring only legitimate data gets through. In 2022, a major investment bank executed incorrect trades costing millions because of faulty system controls, proving that even Wall Street giants need digital trust verification. Fourth, electronic commerce services assess whether online transactions are secure and reliable. Amazon processes over 66,000 orders per hour, each one depending on assurance mechanisms that verify payment processing, inventory systems, and fulfillment operations. Fifth, healthcare performance measurement, specialized services verifying the reliability of healthcare metrics. With healthcare representing nearly 20% of U.S. GDP and Medicare fraud costing billions annually, assurance over healthcare operations isn't optional, it's essential. Finally, Prime Plus services help our seniors with financial verification, especially important as elder financial abuse has become a $3 billion industry. Each of these services applies the universal grammar of assurance to specific dialects of business need. Same principles, different applications. Slide 4, Overview of Attestation Engagements. Attestation engagements represent the accounting profession's version of trust but verify. They occur when a CPA provides an independent conclusion about an assertion made by another party. But why is this necessary? Imagine a dating app where everyone self-reports their height, weight, income, and life accomplishments without verification. The information would quickly become meaningless, as exaggeration becomes the norm. Attestation services prevent this market for lemons problem in business information. In attestation, the practitioner stands between the assertion maker and the assertion user, lending their professional credibility to enhance the reliability of the information. Like a bridge spanning the river of doubt, attestation connects islands of information with the mainland of decision-making. This matters because decisions based on faulty information can have catastrophic consequences. Just ask Lehman Brothers investors or Enron's employees. The defining characteristic of attestation is that the CPA examines someone else's statement rather than making their own. This independence is crucial. It's the difference between a movie critic reviewing a film and the movie's producer telling you it's great. Attestation engagements follow the ATC sections of the AICPA professional standards, which provide the scaffolding for how these engagements should be designed, performed, and reported. These standards ensure consistency across engagements and firms. Imagine if every doctor created their own unique diagnostic procedures. Medical care would be chaos. Similarly, attestation standards create a common language of assurance that markets understand and trust. Slide 5. Types of attestation engagements. Attestation engagements form a spectrum of assurance, varying in both depth and the conclusion provided. Think of them as 3 different security clearance levels, each requiring different levels of evidence and providing different levels of comfort. First, examinations, the platinum standard of attestation. Like a thorough forensic investigation, examinations involve comprehensive procedures to obtain reasonable assurance, a high but not absolute level of certainty. Why not absolute? Because as statisticians remind us, proving a negative with 100% certainty would require examining the entire population, often impossible in practice. In an examination, the practitioner expresses a positive opinion. In our opinion, the assertion is fairly stated. This is analogous to a judge declaring guilty or not guilty after reviewing substantial evidence. Nike's sustainability report might undergo an examination to verify their environmental claims, giving stakeholders confidence that the claims aren't just greenwashing. Second, reviews. The silver standard providing limited assurance. Reviews primarily involve analytical procedures and inquiries, like a detective conducting interviews and analyzing patterns rather than collecting physical evidence. The conclusion is negative. Nothing came to our attention that caused us to believe the assertion is not fairly stated. It's the difference between saying, "I've thoroughly examined this and it looks good," versus, "I've taken a reasonable look and didn't see any red flags." When Under Armour wants some verification of their quarterly financial information before filing with the SEC, a review provides appropriate assurance at lower cost than an examination. Third, agreed upon procedures. The bronze standard, where the practitioner performs specific procedures and reports findings without expressing an opinion, like a laboratory technician reporting test results without diagnosing the patient. AUP engagements provide factual findings for users to interpret themselves. When Microsoft acquires a startup, they might engage a CPA to perform specific procedures on the target's customer contracts, not to provide an opinion, but to report factual findings that Microsoft's acquisition team will interpret. Each type meets different user needs with appropriate levels of cost and assurance, matching the verification approach to the risk and importance of the information. Slide 6. Financial forecasts and projections. Financial forecasts and projections represent one of the most common and valuable applications of attestation services, especially in capital raising and major investment decisions. Governed by ATC Section 305, these engagements address prospective financial information, numbers about the future rather than the past. But as Danish physicist Niels Bohr quipped, prediction is very difficult, especially about the future. So why do we bother attesting to forward-looking information? Because critical business decisions, from launching new product lines to acquiring competitors, depend on expectations about future performance. There are two distinct types of prospective information, and the distinction matters enormously. Financial forecasts present expected results based on conditions management believes will exist and actions management expects to take. It's management's best estimate of the financial future, like a weather forecast predicting tomorrow's conditions based on current atmospheric data and historical patterns. When Tesla raises capital for a new gigafactory, their forecast represents what they genuinely believe will happen. Financial projections, by contrast, answer what-if questions based on hypothetical assumptions that may or may not occur. They're like scientific thought experiments. If we cut prices by 15%, what would happen to our profitability? When Disney evaluates acquiring Marvel, they might create projections based on the hypothetical assumption of releasing 3 Marvel films annually. The key difference? Forecasts represent management's best estimate of what will happen. Projections explore hypothetical scenarios that might happen under specified conditions. This distinction has profound implications for how the information is used and reported. Users must understand which type they're dealing with to avoid misinterpreting the information's meaning and limitations. Slide 7. Introduction to examination reports. Examination reports on prospective financial information serve as the formal communication vehicle between the practitioner and the information's users. These reports have a structured format designed to clearly communicate both the practitioner's conclusion and the limitations of that conclusion. Think of examination reports as the financial equivalent of nutrition labels, standardized formats that allow users to quickly find the information they need while understanding the context. Standard reports include a clear title indicating independence, identification of the prospective information examined, statements of both management's and the practitioner's responsibilities, description of examination procedures, the opinion, and required cautionary language. This structure isn't arbitrary. It evolved to address common misunderstandings and litigation issues that arose when report formats were less standardized. The examination report serves 2 critical functions: communicating the practitioner's conclusion about the prospective information and educating users about the inherent limitations of such information. Like warning labels on medication, these reports aim to prevent misuse by clearly stating what they do and don't cover. The standardized structure also helps users compare different reports, just as standardized food labels make it easier to compare nutritional content across products. When a venture capital firm receives prospective information from multiple startups seeking funding, standardized examination reports make it easier to evaluate the relative reliability of their financial projections. Slide 8, Examination Report on a Forecast, Part 1. In an examination report on a forecast, the independent accountant first establishes the engagement context by clearly delineating responsibilities. The report begins by stating that the accountant has examined the forecast in accordance with attestation standards established by the AICPA. This reference to professional standards is more than boilerplate. It signals that the examination followed rigorous methodology rather than ad hoc procedures. Next, the report emphasizes management's responsibility for preparing the forecast according to AICPA guidelines and for the underlying assumptions. This responsibility statement is crucial because it establishes that management, not the accountant, owns the forecast and its assumptions. It's like the distinction between a building inspector and the architect. The inspector evaluates the building but isn't responsible for its design. This delineation serves both legal and practical purposes. Legally, it clarifies that the practitioner isn't the guarantor of the forecast's accuracy. Practically, it reminds users that management, with its deep understanding of the business, develops the forecast based on their plans and expectations. The forecast is management's story about the future. The practitioner simply evaluates whether that story is presented properly and based on reasonable assumptions. Slide 9, Examination Report on a Forecast, Part 2. The report continues by describing the procedures performed to obtain reasonable assurance, the methodological heart of the examination. The practitioner explains that they evaluated management's preparation process, assessed the support for assumptions, tested the forecast's preparation, and evaluated its overall presentation. This methodology section matters because it helps users understand the basis for the practitioner's opinion. The difference between saying, "Trust me," and explaining your reasoning. The report also notes that the practitioner assessed risks of material misstatement and responded accordingly. The same risk-based approach now standard in financial statement audits. This approach recognizes that not all elements of a forecast carry equal risk. Assumptions about revenue growth typically warrant more scrutiny than assumptions about office supplies expense. By highlighting this risk-based methodology, the report signals that the examination wasn't a mechanical checklist, but a thoughtful professional assessment focused on areas of greatest concern. When GameStop presents a forecast for its digital transformation strategy, the examination would likely focus intensively on assumptions about e-commerce growth and store closures while applying less scrutiny to lower-risk areas. This risk-based approach maximizes the value of the examination by concentrating professional skepticism where it matters most. Slide 10, Examination Report on a Forecast, Part 3. In the opinion section, the practitioner states whether the forecast complies with AICPA guidelines and whether the underlying assumptions provide a reasonable basis for management's forecast. This dual opinion addresses both the forecast's presentation and its foundational assumptions, like evaluating both a building's appearance and its structural integrity. But even the strongest opinion comes with important caveats. The report includes mandatory cautionary language about inherent limitations. Forecasted results may not be achieved, and the longer the forecast period, the greater the likelihood of significant differences between forecast and actual results. This cautionary language isn't just legal protection, it educates users about the inherent uncertainty of future-oriented information. Even the most rigorously examined forecast represents plausible expectations, not guaranteed outcomes. When Spotify forecasts subscriber growth over 5 years, even with a clean examination opinion, users must understand that technological disruption, competitive moves, or changing consumer preferences could significantly alter actual results. The report concludes by stating that the practitioner has no responsibility to update the report for events after its date, recognizing that conditions change continuously while reports are static. This temporal limitation reminds users that an examination report represents a point-in-time evaluation rather than an ongoing monitoring of the forecast's continuing reasonableness. Slide 11, Examination Report on a Projection, Part 1. An examination report on a projection differs from a forecast report in critical ways that reflect the different nature of projections. The report begins by identifying the special purpose for which the projection was prepared, such as evaluating a specific business initiative or negotiating specific financing. This purpose restriction is essential because projections are inherently conditional. They show possible outcomes given hypothetical assumptions, rather than management's actual expectations. The report identifies these hypothetical assumptions, making clear they may or may not occur. Like scientific hypotheticals, if gravity were twice as strong, what would happen? Projections explore what-if scenarios rather than expected outcomes. This conditional nature makes projections inappropriate for general use, but valuable for specific decision contexts. When Uber evaluates entering a new market, they might develop a projection based on hypothetical assumptions about regulatory approval, driver availability, and consumer adoption rates. The examination report would clearly identify these hypothetical assumptions so users understand the projection's conditional nature. This transparency prevents users from misinterpreting the projection as management's best estimate of future results, a critical distinction that affects how the information should influence decisions. Slide 12, Examination Report on a Projection, Part 2. The examination procedures for a projection parallel those for a forecast, evaluating preparation, assessing assumptions, testing calculations, and reviewing presentation. Despite the hypothetical nature of some assumptions, the practitioner applies the same professional rigor to examining projections. The opinion paragraph addresses whether the projection is presented in accordance with AICPA guidelines and whether the assumptions provide a reasonable basis for the projection, given the hypothetical assumptions. This opinion language carefully navigates the projection's conditional nature. The practitioner opines on the projection's reasonableness if the hypothetical assumptions occur, not on the likelihood of those assumptions occurring. It's like saying, if it rains, this umbrella will keep you dry, without opining on whether rain is likely. This conditional opinion recognizes the limits of professional expertise. Accountants can assess whether financial outcomes reasonably follow from assumptions, but aren't qualified to predict whether hypothetical business conditions will materialize. When Netflix projects financial results, assuming they enter sports broadcasting, the examination evaluates whether the financial projections reasonably follow from that assumption, not whether sports broadcasting is a likely strategic direction for the company. Slide 13, Examination Report on a Projection, Part 3. A critical element of a projection report is the explicit restriction on the report's use. The report clearly states it's intended solely for the specified purpose and shouldn't be used for other purposes or by other parties. This restriction recognizes the specialized nature of projections and prevents their misapplication to decisions they weren't designed to inform. The report includes the same cautionary language about inherent limitations and disclaims responsibility for updating the report after its date. These limitations are particularly important for projections, which are inherently more speculative than forecasts due to their hypothetical assumptions. When Microsoft projects the financial impact of a major acquisition, the report would restrict use to those evaluating that specific transaction. If the projection were later used to set general investor expectations, it would be a misapplication of information designed for a different purpose. These restrictions aren't just technicalities. They protect both users from misusing information and practitioners from liability for unintended applications of their work. The projection report represents a specialized tool designed for a specific job, not an all-purpose financial Swiss Army knife. Slide 14, Agreed Upon Procedures Engagements Overview. Agreed Upon Procedures, AUP. Engagements offer a fundamentally different approach to attestation. Rather than providing an opinion or conclusion, the practitioner performs specific procedures and reports factual findings. Think of AUP as the just the facts approach to attestation, like a laboratory reporting test results without diagnosing the patient. In AUP engagements, the practitioner and specified parties agree in advance on specific procedures to be performed. These might include recalculating specific amounts, confirming specific balances, or comparing information to specified criteria. The report describes the procedures performed and the resulting findings without expressing any conclusion about what those findings mean. Why is this approach valuable? Because sometimes users need specific factual information rather than a broad opinion. They want surgical precision rather than a general physical exam. AUP engagements are often more cost-effective than examinations or reviews when users have very specific concerns. When Walmart acquires a regional grocery chain, they might engage a CPA firm to perform agreed-upon procedures on the target's inventory records, counting specific high-value items, testing specific valuation calculations, or verifying specific vendor rebates, rather than obtaining a comprehensive opinion on the entire inventory balance. The users of AUP reports take responsibility for determining the procedure's sufficiency and interpreting the findings. The CPA firm doesn't determine whether the findings are good or bad, just what they are. This division of responsibility allows for precise, focused attestation services tailored to specific user needs. Slide 15, Agreed Upon Procedures for a Forecast, Part 1. In an Agreed Upon Procedures report for a forecast, the practitioner begins by describing the specific procedures performed as agreed with the specified parties. The report clearly identifies the forecast and states that the sufficiency of the procedures is solely the specified party's responsibility. This sufficiency disclaimer is critical. It recognizes that the practitioner isn't determining whether the procedures adequately address the party's information needs. It's like a chef preparing exactly what customers order without advising whether their meal choices constitute a balanced diet. The procedures might include checking mathematical accuracy, comparing assumptions to industry benchmarks, tracing information to supporting documentation, or inquiring about forecast preparation processes. These procedures are tailored to the specified party's concerns, rather than following a standardized approach. When Ford wants specific information about a sales forecast, they might request procedures focused on electric vehicle projections, while not requiring procedures on traditional vehicle segments. This customization allows the engagement to address precisely what matters to users without performing unnecessary work on less relevant areas. Slide 16, Agreed Upon Procedures for a Forecast, Part 2. The findings section presents factual results without expressing an opinion or providing assurance. The report explicitly states that the practitioner didn't audit or review the forecast and doesn't express an opinion or any form of assurance on it. This clear disclaimer prevents users from incorrectly inferring an opinion from the reported findings. The findings are presented objectively. We recalculated the projected gross margin percentage and found it to be 32.5%, rather than evaluatively. The gross margin percentage appears reasonable. This objectivity preserves the fundamental nature of AUP reports as factual rather than judgmental. The specific findings directly correspond to the procedures performed. No procedure, no finding. This direct linkage ensures transparency about the scope and limitations of the engagement. When a private equity firm requests AUP on a target company's customer revenue projections, the findings might include that 85% of projected revenue comes from existing customers, but the report wouldn't opine on whether this customer concentration represents a risk or strength. Slide 17, Agreed Upon Procedures for a Forecast, Part 3. The report includes important limitations, noting that the practitioner has no responsibility to update the report, and that the report is intended solely for the specified parties and should not be used by anyone else. These restrictions recognize the targeted nature of AUP engagements. They're designed to meet specific needs of specific users, rather than provide general-purpose assurance. The report also includes cautionary language about the inherent limitations of forecasts, similar to examination reports. This language reminds users that even when procedures identify no exceptions, forecasted results may differ materially from actual results. When Apple engages a practitioner to perform procedures on a forecast for a new product line, the report might find that all revenue projections are mathematically accurate and consistent with the stated assumptions, but this doesn't guarantee the product will achieve those revenues. The practitioners don't predict the future. They simply report factual findings about the forecast's preparation and documentation. These limitations help prevent misinterpretation of the report's narrow scope and purpose. Slide 18, Accounting and Review Services Overview. Now let's transition to accounting and review services, which are governed by the Statements on Standards for Accounting and Review Services, SSRs, issued by the AICPA. While attestation services can apply to various subject matters, accounting and review services specifically address historical financial statements for non-public entities. Think of these as the Financial Statement Services Toolkit for private companies, providing options less extensive and costly than an audit. These services include preparation of financial statements, compilation of financial statements, and review of financial statements. Each provides a different level of service and assurance, addressing different needs and circumstances. Why are these services important? Because the vast majority of American businesses are private companies that don't require audits, but still need professional assistance with financial reporting. When a local manufacturing company needs financial statements for its bank but doesn't require an audit, these services provide appropriate alternatives. The evolution of these services reflects the accounting profession's recognition that one size doesn't fit all. Different entities need different levels of service based on their size, complexity, user needs, and risk profile. Just as medicine offers options from over-the-counter remedies to complex surgical procedures, accounting provides a spectrum of services to match varying needs and resources. Slide 19, Preparation of Financial Statements. Preparation of financial statements is a non-attest service where the accountant assists management in preparing financial statements without providing any assurance. It's the accounting equivalent of a ghostwriter, helping create the document without publicly endorsing its content. Key characteristics include no verification of information accuracy, no report issuance, and a requirement that each page include a statement that no assurance is provided. This disclaimer prevents users from incorrectly inferring any assurance from the accountant's involvement. Preparation services respond to a practical reality. Many smaller businesses lack the internal expertise to prepare financial statements that comply with applicable reporting frameworks. The service allows these businesses to leverage the accountant's technical expertise without paying for assurance procedures they may not need. When a growing tech startup needs GAAP financial statements for potential investors, but has limited accounting staff, preparation services provide professional assistance without the cost of assurance. While preparation looks similar to bookkeeping, it specifically addresses creating financial statements that comply with an applicable financial reporting framework, adding the final layer of financial reporting rather than maintaining the underlying records. Slide 20. Compilation of financial statements. A compilation is an engagement where the accountant applies accounting and financial reporting expertise to assist management in presenting financial information without providing any assurance. Unlike preparation, a compilation includes issuance of a compilation report, reading the financial statements for obvious material misstatements, and consideration of whether the financial statements are appropriate in form and free from obvious material errors. It's like having an expert review your resume for obvious errors without verifying your claimed accomplishments. If the accountant is not independent, this fact must be disclosed in the compilation report, though lack of independence doesn't preclude performing the compilation. This transparency about independence allows users to consider this factor when evaluating the financial statements. When a family-owned restaurant needs financial statements for its bank, but doesn't require a higher level of service, a compilation provides professional involvement at minimal cost. The compilation adds value through the accountant's reporting expertise and general knowledge of the client and industry, helping present financial information appropriately without the procedures required for assurance services. Slide 21. Report on compilation with full disclosure. A standard compilation report includes a title, a statement that the financial statements were compiled, identification of the financial statements, statements that no audit or review was performed and no opinion or assurances provided, acknowledgement of management's responsibility, and the accountant's signature, location, and date. This report structure clearly communicates the compilation's limited nature to prevent misunderstanding about the level of assurance provided. The report explicitly disclaims any opinion or assurance to establish appropriate expectations for users. Without this clear communication, users might incorrectly assume that the accountant's involvement provides more confidence than a compilation actually delivers. When a local construction company provides compiled financial statements to its bonding company, the compilation report ensures the bonding company understands that while a CPA was involved, they didn't perform verification procedures that would provide assurance. This transparency helps all parties understand the engagement's limitations, while still benefiting from the accountant's expertise in financial statement presentation. Slide 22. Review of financial statements, Part 1. A review engagement provides limited assurance that the financial statements are free from material misstatement. It involves performing inquiry and analytical procedures, obtaining written management representations, and considering whether the financial statements conform to the applicable financial reporting framework. Think of a review as financial statement triage, identifying potential problem areas through analytics and targeted questioning rather than comprehensive testing. A review provides substantially less assurance than an audit, but more than a compilation, making it the middle option in the assurance spectrum for historical financial statements. The practitioner expresses a conclusion about whether they're aware of any material modifications needed for the financial statements to conform to the applicable framework. This negative assurance, based on our review, we're not aware of any material modifications needed, appropriately reflects the limited nature of review procedures. When a successful e-commerce company applies for a $2 million credit line, a review might provide sufficient assurance for the lender without the cost of an audit, especially if the company has a strong relationship with the bank. Slide 23. Review of financial statements, Part 2. The procedures performed during a review typically include inquiries about accounting principles and practices, analytical procedures to identify unusual items or trends, reading financial statements for conformity with the framework, and obtaining management representations. These procedures are designed to identify areas where material misstatements are likely, while acknowledging that many potential misstatements won't be detected. Analytical procedures, comparing current financial data to prior periods, budgets, or industry benchmarks, serve as the primary tool for identifying potential issues. These analytics act like medical screening tests, identifying areas that require closer attention rather than diagnosing specific problems. When analytics identify unusual fluctuations, like gross margin dropping significantly from prior periods, the accountant makes inquiries to understand the business reasons for the change. If the explanations seem reasonable and consistent with other information, additional procedures typically aren't necessary. When a profitable dental practice undergoes a review, analytical procedures might identify that supply expenses increased 40%, while revenue increased only 10%. Inquiries might reveal this resulted from stockpiling supplies due to anticipated shortages, a reasonable business explanation that wouldn't trigger additional procedures. Slide 24, Standard Review Report Overview. A standard review report includes a title indicating it's an independent accountant's review report, appropriate addressee, statements that the review was performed in accordance with SSRs, descriptions of management's and the accountant's responsibilities, and a description of a review engagement and its limitations compared to an audit. This structure ensures users understand both what a review is and what it isn't. The responsibilities section clearly distinguishes between management's responsibility for the financial statements and the accountant's responsibility for conducting the review and expressing a conclusion. This delineation of responsibilities establishes appropriate accountability and helps users understand that management remains primarily responsible for the financial statements, even when they've been reviewed by an independent accountant. The description of a review engagement explains that a review consists primarily of analytical procedures and inquiries, substantially less than an audit, to help users understand the limited nature of the procedures performed. This description manages expectations about the assurance level provided by clearly contrasting reviews with audits. Slide 25, Standard Review Report, Conclusion. The conclusion paragraph states whether the accountant is aware of any material modifications that should be made to the financial statements for them to conform to the applicable financial reporting framework. This negative assurance language, expressing a conclusion based on what the accountant is not aware of, rather than positively affirming what they believe, appropriately reflects the limited procedures performed in a review. The report emphasizes that a review is substantially less in scope than an audit and does not result in the expression of an opinion. This contrast with audit opinions helps users understand the lower assurance level provided by a review. When a mid-sized manufacturing company provides reviewed financial statements to its primary supplier to support extended payment terms, the review report's description of limitations helps the supplier appropriately calibrate their confidence in the financial information. The report concludes with the signature of the accountant or firm, location, and date, establishing who is responsible for the conclusion and when it was reached. Slide 26. Modifications to compilation or review reports. Compilation and review reports may require modifications in certain circumstances, reflecting limitations or issues identified during the engagement. When financial statements depart from the applicable framework, the accountant must disclose the nature of the departure and its effects on the financial statements, if such effects have been determined. This transparency ensures users aren't misled by departures from expected accounting treatment. If the accountant becomes aware of substantial doubt about the entity's ability to continue as a going concern, the report should include an emphasis of matter paragraph describing the uncertainty. This early warning system alerts users to significant viability concerns that might affect their decisions. Other circumstances requiring modifications include lack of independence in a compilation engagement, supplementary information accompanying the financial statements covering more than one period, and restricted use of the report. These modifications ensure the report appropriately communicates engagement circumstances that affect how users should interpret the financial statements. When a retail chain undergoing review has substantial doubt about its ability to continue operating due to declining sales and increasing debt, the emphasis of matter paragraph alerts the financial statement users to this significant uncertainty without expressing an opinion on the company's viability. Slide 27, Introduction to Internal Auditing. Internal auditing represents a distinct profession within the broader assurance landscape, with its own professional standards and practices. The Institute of Internal Auditors defines internal auditing as an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. It helps an organization accomplish its objectives by bringing a systematic, disciplined approach to evaluate and improve the effectiveness of risk management, control, and governance processes. Unlike external auditors who primarily serve external stakeholders, internal auditors work within organizations to serve management and the board. Think of internal audit as the organization's immune system, continuously monitoring for control weaknesses, inefficiencies, and compliance issues before they become serious problems. Internal auditing serves dual roles, providing assurance about governance, risk management, and control processes, and providing consulting services to help improve these processes. This dual mandate makes internal audit both an evaluator and a partner in organizational improvement. When JP Morgan Chase's internal audit department evaluates new digital banking controls, they both assess the controls' adequacy and recommend improvements, combining assurance with value-added consulting. Internal auditors typically report administratively to senior management and functionally to the audit committee of the board of directors, ensuring their independence within the organization while maintaining operational effectiveness. Slide 28, Institute of Internal Auditors, IA Standards. The Institute of Internal Auditors, IIA, establishes standards for the professional practice of internal auditing through its International Professional Practices Framework, IPPF. This framework includes both mandatory guidance, like the definition of internal auditing, code of ethics, and standards, and recommended guidance, like implementation guides and practice advisories. The IIA recently updated its standards around 5 domains that form an integrated framework for effective internal audit practice. First, purpose, the why of internal audit, addressing the mission, mandate, and value proposition of the function. This domain ensures internal audit aligns with organizational objectives and stakeholder expectations. Second, people, the who of internal audit, covering the competence, objectivity, and development of internal audit professionals. This domain recognizes that internal audit effectiveness ultimately depends on the quality of its people. Third, performance, the how well of internal audit, addressing the quality of internal audit work, from planning through reporting. This domain ensures that internal audit activities meet professional standards and deliver value. Fourth, planning, the what and when of internal audit, ensuring that audit resources focus on the highest risk areas and align with organizational priorities. This domain recognizes that internal audit must be strategic in deploying limited resources. Fifth, progress, the where are we going of internal audit, addressing continuous improvement and innovation. This domain ensures that internal audit functions evolve with changing risks and stakeholder expectations. Together, these domains create a comprehensive framework for internal audit excellence, addressing all aspects of the function's design and operation. When Microsoft's internal audit department adopts these standards, they provide a structured approach for evaluating and improving the function's effectiveness across all dimensions of its operations. Slide 29. Internal auditor's roles and external auditor. Interaction. Internal auditors perform various roles within organizations, including evaluating risks and controls, assessing compliance, conducting financial and operational audits, investigating fraud, and providing consulting services. This broad mandate makes internal audit a versatile resource, addressing diverse organizational needs beyond financial reporting. External auditors may rely on the work of internal auditors under certain conditions. The internal audit function must be independent and objective. Internal auditors must possess adequate professional competence. Internal auditors must apply due professional care. And there must be effective communication between internal and external auditors. This collaboration can improve audit efficiency by leveraging internal audit work rather than duplicating efforts. Before relying on internal audit work, external auditors must evaluate the function's objectivity, competence, and quality control, essentially auditing the internal auditors before using their work. External auditors will typically reperform some internal audit work to validate its quality and reliability. When Goldman Sachs undergoes its annual financial statement audit, the external auditors might rely on internal audit's testing of certain IT controls after evaluating the internal audit function's independence, competence, and methodology. This reliance can reduce external audit costs while maintaining audit quality, a win for both the company and its external auditors. Slide 30. Trust Services and SOC Reports. Trust Services and System and Organization Controls (SOC) reports provide assurance about controls in service organizations and information systems. As businesses increasingly outsource critical functions to service providers, these specialized attestation services address the resulting assurance needs. Trust Services criteria include security, protection against unauthorized access, availability, system availability for operation and use, processing integrity, complete, valid, accurate, timely, and authorized processing, confidentiality, protection of confidential information, and privacy, appropriate handling of personal information. These criteria provide a framework for evaluating and reporting on controls across different dimensions of system reliability. SOC reports include SOC 1, controls relevant to user entities' financial reporting. SOC 2, controls relevant to trust services criteria. SOC 3, general use reports on trust services criteria. And SOC for cybersecurity risk management programs. These reports help service organizations demonstrate control effectiveness to their customers, reducing the need for multiple customer audits. When Amazon Web Services provides cloud computing services to thousands of companies, SOC 2 reports allow AWS to efficiently demonstrate security, availability, and confidentiality controls to all customers rather than accommodating individual customer audits. Similarly, when a payroll service provider processes transactions for hundreds of companies, a SOC 1 report allows the provider to demonstrate the effectiveness of controls relevant to customers' financial reporting, helping those customers and their auditors assess risks associated with outsourced payroll processing. Conclusion. As we conclude our whirlwind tour of assurance, attestation, and internal auditing services, let's return to our central theme. To learn accounting, you must do accounting. The concepts we've covered today, from the spectrum of assurance services to the intricacies of examination reports, only become truly meaningful when applied in practice. As you continue your accounting journey, seek opportunities to engage with these services directly, whether through case studies, internships, or professional work experience. Remember that these services aren't just technical exercises. They're vital economic functions that facilitate trust in markets and organizations. Without reliable assurance mechanisms, our financial system would collapse under the weight of information asymmetry and distrust. The next time you see a company raise capital, secure financing, or report financial results, recognize the invisible infrastructure of assurance services making those activities possible. Whether you pursue a career specifically in assurance or in another area of accounting or business, understanding these services will enhance your professional judgment and decision-making. The critical thinking skills these services demand, professional skepticism, evidence evaluation, and clear communication, transfer to virtually any professional context. As Warren Buffett observed, accounting is the language of business, and assurance services ensure that language communicates truth rather than fiction. Thank you for your attention today. I'm happy to address any questions you may have.